I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Tuesday, March the 3rd. Welcome to our Global Markets Commentary. February brought a lot of developments for capital markets to digest, and it was another solid month for well-diversified investors as global stock markets outside of the U.S. padded gains, and bonds joined the rally too. All this feels like a distant memory, given the rapidly evolving events in the Middle East to open March. Capital markets have a long history of looking past geopolitical events. There is often an initial risk-off reaction, followed by recovery as investors return to focusing on the fundamentals and ask what the medium to longer-term impact might be on global growth and corporate earnings, inflation, and interest rates. For the Middle East, the obvious transmission mechanism is through oil prices. Oil prices that back in December were at their lowest level in 5 years have been rising in 2026 on expectations of stronger global growth, and spiking in the past few days on the breakout of Iranian hostilities. This reaction is to be expected. But the world has navigated oil shocks in the past, most recently with the war in Ukraine. Oil will continue to be volatile, but a short-term spike doesn't threaten the fundamentals markets care about, which is the solid trajectory of global growth and, in turn, corporate earnings. Higher oil prices can impact inflation, but again, the current levels are manageable, and investors can look through a short-term spike. A quick return to lower oil prices is to be expected on a return to stability. Bond yields rose in early March, but only because they had fallen on safe haven demand leading up to the outbreak of hostilities, and the outcomes were less severe than feared. Bottom line, inflation is poised to remain in check, allowing central banks to stay accommodative and bond yields to stay stable, requiring little repricing to other assets. There is the possibility that the weakening of the Iranian regime brings less instability to the region, a positive outcome for global growth and oil prices, and hopefully for the people of the Middle East as well. The second major theme in markets lately is the shifting narrative on artificial intelligence, from market darling, amazing technological advance to destroyer of everything it touches. Weakness in U.S. equity markets stems from the view that those building out AI, the hyperscalers, are overspending on the build-out, and those who were thought to benefit from deploying AI, from software enterprise companies to trucking companies, are now going to be eaten by AI. Add to this the notion that AI will kill so many jobs that the whole thing is now an AI apocalypse. It is unknowable where all this will lead in the years to come, but our research and conversations with many who are closest to this technological innovation take a more nuanced approach to the outcomes. Whatever transformation comes will be evolutionary, not revolutionary. Now, it isn't all going to be roses, nor is it an apocalypse. We do believe AI will transform certain industries and certain jobs, but that, like all technological advances in history, new industries and jobs will be born out of that creative destruction. Recent high-profile job cuts in the technology sector are often company-specific headlines and have more to do with right-sizing previously inflated hiring and less to do with AI job replacement. Some are being accused of using AI as cover for these realities. Investors who have been taking a diversified approach and reaping profits along the way are enjoying prudent participation in these areas of technological advance. Two other developments to mention quickly, and both we see as well understood and not the central driver of capital markets, but they are grabbing headlines. The U.S. Supreme Court striking down the IEEPA tariffs and turmoil in some areas of private credit. On tariffs, the administration has other means to levy tariffs. There will be ink spilt on how refunds may or may not play out, but the use of tariffs as a broad cudgel has been restrained. This is a welcome development, but we don't see it as the endgame. Companies are resigned to tariffs being here to stay for the foreseeable future, and they continue to adapt and move on. As for private credit, the negative headlines are targeted at a subset of the players, and these kinds of episodes are not new in this asset class. It doesn't mean that all private credit is bad. We don't see it as widespread rot, and it isn't causing contagion. Akin to what happened to regional banks when Silicon Valley and First Republic went bust in 2023, publicly traded shares of private credit asset managers are being shunned across the board until the dust settles. The bottom line, there remains plenty for investors to digest. Capital markets are functioning well, incorporating the new information, and despite the headlines, not all of it is bad. That's the way we saw the month of February 2026. Thank you for joining us. We look forward to you tuning in next month.